Welcome to RBC's Markets in Motion podcast, recorded August 12th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, 3 big things you need to know. First, last week's price action relieved some pressures on the stock market, but didn't solve its major problems. Second, earnings remain solid with no major deterioration in corporate tone. Third, we'd be more selective with value-oriented defensive sectors going forward. If you'd like to hear more, here's another 5, maybe 6 minutes. Now let's jump into the details. We'll start with takeaway number 1. Last week's price action released some pressure for the U.S. equity market, but didn't fully solve its problems. We're optimistic that a short-term bottom was put in place on August 5th, when the S&P 500 closed down 8.5% from peak, within the range of a normal healthy pullback of 5-10%. Important technical support levels did hold. But we remain on guard for choppy conditions to persist a bit longer and don't rule out a growth scare, a drawdown of say 14 to 19%, similar to 2010, 2011, and 2015-2016, if economic data releases continue to disappoint. For now, our 5,700 year-end 2024 price target stands. Though none of the stock market's problems were really fixed last week, some pressure was released. AAII net bulls are no longer sitting at one standard deviation above the long-term average and have pulled back into neutral territory, though not deeply oversold territory. And the median PE of the top 10 names in the S&P has fallen to around 24 times, down from 32 times at the recent intra-month high, but it's still well above its average of 18 times. Some problems remain, however. Seasonality has been a problem for stocks the last few years, not just in August, but September and October. September, when many sell-side firms hold conferences, will be tricky as companies tend to be reluctant to provide too much forward-looking commentary that time of year. The U.S. election tends to be accompanied by softness in equity markets in September and October as well, and it will still be unresolved. And rate cuts will remain top of mind, including the tendency of U.S. equities to fall after first cuts in recent cycles. Moving on to takeaway 2. Earnings remain solid. There was no major change in tone on earnings calls last week, despite some incremental negative commentary on the consumer. On the stats, the percent of companies in the S&P beating consensus forecasts on earnings continues to outpace that beating on sales by a margin of 80% to 59%, but both of those stats remain up a little bit from the last reporting season. And earnings sentiment is essentially neutral as the rate of upward revisions is tracking at 47%. We continue to see very little change in bottom-up earnings forecasts for 2024, which is tracking at 244, and 2025, which is tracking at 278.80. Investors seem to be ignoring earnings in some respects. Companies beating consensus earnings forecasts are actually underperforming in terms of price reaction, something that's not normally the case. As we've read through earnings call transcripts, we've been monitoring whether recent events have had an adverse impact on corporate confidence that could lead to more cautious company behavior on labor. We simply don't see evidence that this is occurring right now. Some highlights. One industrial company commented that macro uncertainty is a bit higher than a few months ago and that they're watching what happens with the consumer, Fed, and economy closely. We think this does a good job of summarizing where many companies and investors' heads are at right now. Consumer commentary was admittedly a bit more negative last week, with travel coming into focus. Negative comments from certain companies got a lot of attention, but we also saw more positive commentaries from others get essentially ignored. On labor and layoffs, there was no real change. Not much that we saw in general and not much that alarmed us. One company commented they are not particularly worried from one report that we're heading into some sort of kind of consumer recession. This struck us as helpful to understanding the state of the corporate mindset right now. And on recent volatility, we also didn't find a lot. One company noted it was too early to determine if there had been a market turn. We don't doubt that a continuation of heightened market volatility or a string of sizable economic data misses would adversely impact corporate confidence, but we just haven't hit that point yet. Beyond our reading, we also did some quantitative trend analysis of things companies are talking about in earnings calls. We looked at the Russell 3000 and S&P 1500 universes. Some highlights. References to uncertainty and risk have been much lower than 2016 and 2022, and references to confidence have been moving up, a trend generally in place post-COVID. Layoff and job cut commentary has been low, unlike 2020 and 2022, but similar to 2015-2016 when the U.S. experienced a growth scare, though not a recession. Labor commentary generally has been coming down off extreme highs in 2021. References to slowing conditions have been coming down as well, unlike 2015, 2019, and 2022. And recession references have been low and trending down as well, unlike what we saw in 2015, 2020, and 2022. While things could obviously change, it's important to monitor the conversation. For now, companies still seem to be in a zone of calm. We'll wrap up with takeaway number 3. We'd be more selective on value-oriented defensive sectors going forward. As we were reviewing our sector charts Friday, one thing that stood out to us was how value-oriented defensive sectors, specifically REITs and utilities, within the S&P 500 have outperformed the most so far in the third quarter. Both benefit from a rotation into value and trade defensively. Our top-down tools suggest being a little bit more selective in both going forward and make a case for utilities, which we've been overweight, over REITs, which we've been underweight. Flows to utility funds have been positive and are continuing to improve. Flows to U.S. REIT funds have also recently turned positive, but are a bit weaker than what we see in utilities. Valuations seem to have gotten less appealing for both sectors, but again look better for utilities. Although utilities are now a little above average on median PE, the sector is still a little bit below average on a median PE relative to the broader S&P. For REITs, we look at both market cap and median price to FFO multiples to gauge valuation for the sector. Those have been well below average levels throughout 2024, but are now close to historical averages, suggesting the valuation opportunity has eroded. Though it's a cyclical sector by nature and may not really get going until consumer and economic clouds clear, we have gotten incrementally more interested in financials recently, a sector we've been overweight. The sector was looking a little pricey in our valuation model in the S&P recently, but it's now looking slightly attractive again. Financials is also now only one of 2 sectors within the S&P that's been seeing positive revisions on the sell side to both earnings and revenue forecasts. That's all for now. Thanks for listening, and be sure to reach out to your RBC representatives with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.